In the first quarter of 2026, the Philippine stock market was one of the most hostile financial environments in the world. While global indices struggled, the local exchange saw a consistent, punishing decline in valuation. For the average retail investor, this specific type of bear market triggers a standard psychological collapse. During this period, reflected a total exhaustion of optimism. The prevailing consensus suggested that the market had no bottom, making any strategy for profitability appear highly improbable. Survival in this environment depends entirely on a trader's ability to suppress the urge to mirror the general panic. The numbers on the screen are often less dangerous than the emotional response they provoke. However, the main FMS tracker for Q1 2026 reveals a different story. This chart shows the macro index in a deep dive, contrasted against a portfolio that managed to maintain a steady upward trajectory. This episode reverse engineers the specific psychology and trade mechanics used to generate a return when the public narrative was overwhelmingly negative. Success under these conditions requires managing cognitive dissonance. It is the mental strain of watching your personal data improve while the rest of the market reacts to fear. Withstanding that strain requires a complete divorce from public sentiment, relying exclusively on the cold reality of a personal ledger. Quarterly data began with a January net profit of $7,176.94 and $7,586.44 in February. Deconstructing January reveals a hidden engine. Nearly $6,000 came from an ICT dividend. February followed a similar pattern, with a $4,410 MBT dividend providing the bulk of returns. These heavy cash flows served as a psychological safety net. By securing passive returns early, the portfolio removed the emotional pressure to chase risky, low-conviction trades to stay afloat. The early months provided the mental margin and capital security needed to pivot toward more aggressive setups as the quarter progressed. By March, that stability led to a significant payoff, with net profits jumping to $12,351.47. The strategy shifted during this window, moving from defensive dividend collection to active capital gains, leveraging the cushion built in the previous 2 months. These gains were primarily driven by disciplined entries and exits in 2 specific tickers, APX and SGP. Execution on APX involved multiple disciplined sell orders throughout the month, capturing compounding profits of $1,483 and $2,787 across different tranches. Secondary trades on SGP added another $2,000 in active profit, further strengthening the month's performance. The capital gains seen in March were made possible by the results of January and February. Because the dividend safety net eliminated the need to force a performance, the trades could be executed with high precision. Evaluating this run against a hostile macro environment raises a final question. What does the raw data say about the quality of this quarter? This Q1 performance qualifies as the account's best run to date. It is defined not by sheer volume, at indices of the macro market, and focus on the math of your personal tracker. That is the only data that matters for Q2.